There are question marks on whether the growth can be sustained as we move towards the end of the year. Inflow work showed the smallest rise since the start of 2014, and job creations also slowed. Sluggish growth, weaker forward-looking indicators, and downturn in price pressures all point to the Fed holding off for rate increase until next year. That is from Dr. Williamson. However, Chair Yellen echoed that it will, and we'll get to that in just a minute here. Let me get the service PMI, and then we'll go to the Fed. A little different way of doing it here, but we'll get it done. Slower service sector growth and weaker cost inflation contribute to the sharpest fall in price change for almost 3 years. And we'll get to this. This is the market flash. Service PMI, they've got a trademark on it. Business activity index has signaled a slight loss of momentum across the service economy in September at 55.6, down from 56.1 in August. The headline index, which is based on approximately 85% of the usual monthly replies, remains comfortably above the 50. Survey respondents note improved domestic economic conditions continue to support activity growth during September, especially among consumer-focused providers. However, anecdotal information also suggests that some clients had delayed committing to new projects. Reflecting the latest survey data indicates a slowdown overall new business growth for the second month running. Softer growth on new work contributed to a decline in unfinished business for the third time in the past 4 months. Although only modestly, the latest reduction in backlogs was the fastest since April of 2014, suggesting a general lack of pressure on operating capacity. Meanwhile, payroll numbers increased at a slower pace for 3 months in September, but the rate of staff hires was still robust and compared to post-crisis average, that was post-depression. Looking ahead, the service providers remain optimistic about their perspective for business activity during the next 12 months. Anecdotal evidence aside, expectations of improved consumer demand and supportive economic conditions. However, the balance of firms expecting a rise in business activity eased from May's recent peak and was the slowest since June of 2012. Input inflation dropped to its lowest for several months in September, while service producers mostly attributed to the influence of decreased fuel costs, the same as in Germany. Reduced cost pressures, strong competition from new work contributed to a fall in average tariffs for the second month running, represented the first back-to-back declines since the survey began in the late 2009. Although only modest, the latest reduction for service sector charges was the fastest since 2010. At 55.3 in September, down from 55.7 in August. Seasonally adjusted flash market flash U.S. composite output index posted above the neutral 50 for the third consecutive month. The latest composite data also highlights a further reduction in average price charged by U.S. private sector companies at 48.8 in September. The seasonally adjusted index was down from 49.9 in August, the lowest in this series since October of 2009. The composite is based on the original survey of data from Markets U.S. Service PMI and the Market Manufacturing PMI from Dr. Williamson. The survey points to substantial steady expansion of the U.S. economy at the end of Q3. The various warning lights are now flashing brighter, and meaning growth may continue to weaken in the coming months. Although the survey suggests the economy's expansion at 2.2 annualized rate in Q3 2023. Growth slowed in September and could further weaken in coming months. Business optimism slumped to one of the lowest levels seen since the global financial crisis or depression. Inflows of new business rose at the weakest rate for 8 months. Job creation slipped to a 6-month low. Growth is also becoming increasingly reliant on the service economy as manufacturing was sluggish, as we reported there. Average price charged for goods and services are falling at a faster rate since the survey began in 2009, with growth slowing and warning lights flashing, and changes falling at a faster rate for at least 6 months. 6 years, The report data plays into the hands of dovish policymakers and will reduce the odds of an interest rate hike anytime soon. That's Dr. Williamson's take. Let me go to the Fed and their report. Here, we'll find it in a minute. Here we go. This is by Dr. Yellen. This is the Philip Gamble Memorial Lecture at the University of Massachusetts at Amherst. Inflation Dynamics and Monetary Policy. Here I would like to thank Michael Ash for his introductory remarks. My remarks today, I will discuss inflation, its role in the Federal Reserve's conduct of monetary policy. I begin my review by the history of inflation in the U.S. since the 1960s, highlighting 2 points. That inflation is now much more stable than it used to be, and that it is currently running at a very low level. I will then consider the costs associated with inflation. While these costs suggest that the Federal Reserve tries to keep inflation close to 2%. After brief reviewing our policy and actions since the financial crisis, I will discuss the dynamics of inflation and their output on the impact of monetary policy. Historical responsibility of any central bank is to control inflation. The average rate of increase in the prices of broad groups of goods and services. Keeping inflation stable at a modestly low level is important because, for reasons I will discuss, that inflation is highly excessively low and unstably imposes significant costs on households and business. As a result, inflation control is one half of the dual mandate, and we talked about this in the Federal Reserve, pursuant to maximum employment and price stability. The Federal Reserve has not always been successful in fulfilling the price stability element of its mandate. Dash the red line. Well, anyway, the personal consumption expenditure, that's PEC. I won't go into all of this. It's a very long report here, but the second most important feature of inflation over this period can be seen if we examine an estimate of its long-term trend, which is plotted at the dot line anyway. We don't have that here. Too many economists believe that these features of inflation in the late 60s and 70s, its highest level and lack of a stable anchor, reflected a combination of factors including chronic overheated labor and product market, the effects of the energy and food stock prices, the emergence of inflationary psychology, and we've talked about that before, whereby a rise in actual inflation led people to revise up their expectations for future inflation. Together, these factors created these various factors caused inflation, actual and expected, to ratchet higher over time. Ultimately, however, monetary policy bears responsibility for the broad contour of what happened to actual and expected inflation during the period, because the Federal Reserve was insufficiently focused on returning inflation to predictable low levels following the shocks to food and energy prices and other distributions. In 1979, the Fed began significant tightening of monetary policy to reduce, that was under Dr. Paul Volcker, to reduce inflation in response to the tightening, which precipitated a severe economic downturn in the early 80s, and overall inflation moved persistently lower, averaging less than 4%. From 1983 to 1990, inflation came down following the 1990-91 recession and subsequent low recovery, then averaging about 2% for many years. Since the end in 2009, however, the U.S. has experienced inflation running appreciably below the 2% mark. And this is very, very important. But 4% is not a bad level of inflation. Examining behavior of inflation, estimate long-term trends, revise another important change in inflation dynamics, with a caveat that these results are based upon specific implementations of particular statistical model. They imply that since the mid-90s there has been no persistent movement in the predictive long-run inflation rate, which have remained very close to 2%. Recent severe recessions, which saw the unemployment rate rise to levels compared to those seen in 1981-82, that was on the Mr. Reagan downturn. The trends did not shift down markedly. As I will discuss, the stability of this trend appears linked to a change in behavior of long-term inflation expectation. And we'll skip around here. In 2012, the FOC, that's the Open Market Committee, adopted for the first time explicit long-run inflation objective of 2%. Other central banks, the European Central Bank, the Bank of England, have also a 2% policy. An unexpected rise in inflation also tends to reduce real purchasing power of labor income for the first time, because normal wages and salaries are generally slow to adjust to movement. And that's why we talk more and more about pegging increases to inflation, and also certain entitlements like Social Security to inflation. Inflation that is persistently very low can also be costly, and such costs have been particularly relevant to monetary policy in recent years. The most important cost is very low inflation constrains the central bank's ability to combat recessions. Normally, the FOMC fights economic downturns by reducing the normal federal fund rates, the rates charged banks to lend to each other. That's the overnight rate, they call it. Current and expected stimulus spending and hiring by lowering long-term real interest rates that is normally adjusted for inflation. Thus, the lower FOC can feasibly push the real federal fund rates, essentially the negative value of the inflation rate. The Federal Reserve has less room to ease monetary policy when inflation is very low. This limitation is potentially a very serious problem because severe downturns such as the Great Recession, we call it depression, may require pushing real interest rates far below zero. This is called a negative, the negative rate. For this reason, pursuing too low of an inflation objective or otherwise tolerating persistently very low inflation would be inconsistent with the mandate of maximum employment. An unexpected decline in inflation that is sizable and persistent can be very costly because of the debt burden of borrowers. Consider homeowners also take out a conventional fixed-rate mortgage with the expectation that inflation will remain close to 2%. Their normal income will rise about 4% per year, and if the economy were instead to experience chronic mild deflation accompanied by flat or declining normal income, then after a few years the homeowner might find it noticeably more difficult to cover the mortgage payments than they had originally anticipated. Moreover, if equity in their home would be lower than they also anticipated there. monetary policy action since the financial